My $17,000 secret, it's not what you think. You might be imagining a quick, effortless windfall, but let me tell you, the reality is far more nuanced and rewarding. You're here because you saw the title. Maybe it piqued your curiosity, or perhaps it sparked a bit of skepticism. Either way, you're in the right place. $17,000 per week from stocks? It sounds like a dream come true, doesn't it? But let's dig deeper. Sounds too good to be true, right? Well, it might be. The stock market is a complex and often unpredictable arena. I'm not promising you'll get rich quick. In fact, if anyone does, you should probably run the other way. In fact, I'm telling you that's a fantasy. The idea of instant wealth is a captivating illusion, but it's just that, an illusion. This essay is about something different, building wealth over time. It's about the journey, the learning, and the growth that comes with it. It's about making smart choices with your money. Every decision you make can either bring you closer to your financial goals or set you back. It's about understanding the stock market and investing responsibly. This means doing your homework, staying informed, and not letting emotions drive your decisions. My $17,000 weekly return, it's not a fluke or a stroke of luck. That's a result of years of learning, patience, and a bit of luck. It's about the long hours spent studying market trends, the countless mistakes made and learned from, and the unwavering commitment to a long-term strategy. This essay will help you lay the groundwork for your own success story. It will guide you through the principles of sound investing and financial planning. It won't be overnight, but it will be worth it. The road to financial independence is paved with diligence, discipline, and a willingness to learn. This is about taking control of your financial future. Ready to get started? Let's embark on this journey together, one step at a time, and build a future where financial freedom is not just a dream, but a reality. Investing 101, grasping the fundamentals. Before you dive headfirst into the stock market, you need to understand the basics. Just like any other field, investing has its own set of principles and terminologies that you need to be familiar with. This knowledge will not only help you make informed decisions, but also protect you from potential pitfalls. Imagine trying to build a house without knowing what a brick or a beam is. You wouldn't get very far, would you? The same goes for investing. You need to know what stocks, bonds, and other investment vehicles are before you can effectively use them. Stocks represent ownership in a company. When you buy a stock, you're essentially buying a tiny piece of that company. This means you have a claim on part of the company's assets and earnings. The value of your stock can go up or down based on the company's performance and other market factors. When you buy a stock, you're buying a tiny piece of that company. This ownership can give you voting rights in some cases, and you may receive dividends, which are a portion of the company's profits distributed to shareholders. However, it's important to remember that stocks can be volatile and their prices can fluctuate widely. Bonds, on the other hand, are like loans you give to a company or the government. When you buy a bond, you're lending money to the issuer in exchange for periodic interest payments and the return of the bond's face value when it matures. Bonds are generally considered safer than stocks, but they also offer lower potential returns. Don't put all your eggs in one basket. This age-old advice is particularly relevant in investing. Diversification is the practice of spreading your investments across different assets to reduce risk. By doing so, you can protect yourself from significant losses if one investment performs poorly. Spread your investments across different companies, industries, and asset classes. This way, the poor performance of one investment won't have a devastating impact on your overall portfolio. Diversification can help you achieve a more stable and consistent return over time. Risk tolerance is another important concept. It refers to how comfortable you are with the possibility of losing money. Everyone has a different level of risk tolerance, and it's influenced by factors such as your financial goals, investment timeline, and personal comfort level with uncertainty. This refers to how comfortable you are with the possibility of losing money. Understanding your risk tolerance is crucial because it will guide your investment choices. If you're risk-averse, you might prefer safer investments like bonds. If you're willing to take on more risk for the chance of higher returns, you might lean towards stocks. Understanding these fundamentals is crucial. They form the foundation of your investment knowledge and strategy. Without a solid grasp of these basics, you're more likely to make mistakes that could cost you money. It's the foundation upon which you'll build your investment strategy. Just like a house needs a strong foundation to stand tall, your investment portfolio needs a solid understanding of the fundamentals to grow and thrive, so take the time to learn and understand these concepts before you start investing. Beginner-friendly strategies, your path to growth. Whether you're just starting out or looking to refine your approach, these strategies can help you navigate the complex world of investing with confidence. Now that you understand the basics, let's talk strategy. It's important to have a clear plan in place to guide your investment decisions and help you stay focused on your long-term goals. Don't worry, you don't need to be a Wall Street whiz to succeed. With the right strategies, anyone can build a successful investment portfolio. Dollar-cost averaging is a great strategy for beginners. This approach involves investing a fixed amount of money at regular intervals, regardless of market ups and downs. By doing so, you can reduce the impact of market volatility and avoid the temptation to time the market. It involves investing a fixed amount of money at regular intervals, regardless of market ups and downs. This consistent approach helps you build your portfolio over time, taking advantage of both high and low market prices. This helps mitigate risk and takes the emotion out of investing. By sticking to a regular investment schedule, you can avoid making impulsive decisions based on short-term market movements. Index fund investing is another solid option. These funds track a specific market index like the S&P 500 and offer a simple way to diversify your portfolio. Index funds track a specific market index like the S&P 500. By investing in an index fund, you can gain exposure to a broad range of companies without having to pick individual stocks. They offer instant diversification and are generally low cost. This makes them an attractive option for investors who want to minimize fees and maximize returns. The buy and hold strategy is exactly what it sounds like. You buy quality investments and hold on to them for the long term, riding out market fluctuations. This approach allows you to benefit from the long-term growth potential of your investments. You buy quality investments and hold on to them for the long term, riding out market fluctuations. By staying invested, you can take advantage of the power of compounding and grow your wealth over time. Finally, consider the index and a few approach. This strategy involves investing the majority of your portfolio in index funds and allocating a small percentage to individual stocks that you believe in. This way, you can benefit from the stability and diversification of index funds, while also having the opportunity to potentially outperform the market with your individual stock picks. Invest the majority of your portfolio in index funds and allocate a small percentage to individual stocks that you believe in. This balanced approach allows you to manage risk while still having the potential for higher returns. Remember, the key to successful investing is to stay disciplined, be patient, and keep your long-term goals in mind. Finding the right broker. Your gateway to the market. To start investing, you'll need a brokerage account. Think of it as your gateway to the stock market. Choosing the right broker is important. Look for a platform that is reputable, user-friendly, and offers the features you need. Consider factors like trading fees, account minimums, research tools, and customer support. Don't be afraid to shop around and compare different brokers before making a decision. Section 5. Building your investment portfolio, a step-by-step guide. Building a well-diversified investment portfolio is crucial for managing risk and maximizing returns. Start by determining your investment goals and risk tolerance. Are you saving for retirement? A down payment on a house? Your risk tolerance will depend on your time horizon and comfort level with market volatility. Next, decide on your asset allocation. This refers to the percentage of your portfolio you'll allocate to different asset classes such as stocks, bonds, and real estate. Finally, select your investments. Consider a mix of index funds, individual stocks, and other asset classes based on your goals and risk tolerance. Section 6. Staying on top managing your investments. Investing is not a set-it-and-forget-it endeavor. It requires ongoing monitoring and adjustments. Regularly review your portfolio's performance and make sure it's still aligned with your goals. Don't panic sell if the market takes a dip. Remember, you're in it for the long haul. Rebalance your portfolio as needed. Over time, some investments may outperform others, causing your asset allocation to drift. Rebalancing brings your portfolio back to your desired allocation. Section 7. Avoiding rookie mistakes. Don't fall into these traps. Even experienced investors make mistakes, but there are some common pitfalls that beginners can avoid. Don't chase short-term gains. It's tempting to jump on the latest hot stock, but often, these investments are driven by hype and speculation. Avoid emotional investing. Don't let fear or greed dictate your investment decisions. Stick to your plan. Don't put all your eggs in one basket. Diversification is key to managing risk. Section 8. Keep learning, resources for continuous growth. The world of investing is constantly evolving. To stay ahead of the curve, you need to be a lifelong learner. There are countless resources available to help you expand your knowledge and refine your investment strategies. Read books, listen to podcasts, take online courses, and follow reputable financial news sources. Section 9. The Journey to Financial Success. Start investing today. Congratulations! You've taken the first step towards taking control of your financial future. Remember, investing is a marathon, not a sprint. It's about making smart, informed decisions and staying the course. Start small, be patient, and never stop learning. The power of compounding will work its magic over time. Now go out there and start investing. Your future self will thank you.